Good investing is overwhelmingly just about how you behave. It's about your relationship with greed and fear and your ability to take a long-term mindset.
Hi, my name is Veronica, and today we'll talk about the key takeaways of a renowned finance writer and the author of The Psychology of Money, Morgan Housel. His timeless observations will help you find a new perspective on making the right financial decisions. So let's get started. Winning in investing requires playing a different game than everyone else. This is a very powerful insight that has an enormous impact on everyone regardless of one's background, nationality, and education. Comparing yourself to others and comparing your actions to the actions taken by other people is never a good idea, because we don't know the whole story that's behind someone's decision. What works for someone else can be disastrous to us. It's especially dangerous to do it in relation to planning your personal finances and making investment decisions. Assuming that when someone acts a certain way means that this person knows exactly what he's doing, so we should do the exact same thing, is plain irrational in finances. Especially when considering what stock to purchase and at what price. We should create an inner critique that questions each piece of advice we get, and when we're tempted to follow someone's steps without a deeper understanding of the bigger picture. This is why, first and foremost, we need to distinguish what game we're playing, and that almost certainly it's a different one than the rest of the investors play.
There's a really powerful kind of logical idea that investors are playing the same game, that we're all investing in the stock market. We're often buying the exact same stocks, so therefore we're doing the same thing. And I think nothing could be further from the truth, that you have everything from high frequency traders on one end to pensions and endowments that have century long time horizons on the other, and everything in between. And to think that those investors should agree on what the right price of a stock is, or agree on what news is pertinent, or agree on what the next best move is to do in the market is ridiculous. Like, we're all playing completely different games. And what's so important about this is that most investors who don't distinguish one game from another are liable to take their cues from investors who are playing a different game.
Why 90% of investing comes down to mastering three things: living below your means, investing for the long term, and expecting volatility. Morgan Housel's idea of being capable of managing personal finances in a satisfactory and successful way in the long run consists of basic and fundamental principles everyone can live by, regardless of background, education, and expertise. His major observation states that usually sophisticated financial professionals search for intellectually stimulating activities, which are complex and require technical skills, which account for around 10% of investing opportunities. On the other hand, 90% of investing opportunities could be pursued just by following the three basic rules he mentions.
So it's not that getting your MBA and learning how to price derivatives in a Black-Scholes model, it's not that that's bad. That's not my argument. A lot of that stuff is great, and we've made a lot of progress in the field of finance in the last century. The idea of buying stocks for their net present value of future discounted cash flows, that's only been with us since about 1938. A lot of these really important things that you and I probably take for granted are new discoveries. So I'm not discounting that. But in finance, in money, three things: living below your means, investing for the long term, and expecting volatility. Those three basic things that are so easy, so boring, so basic, that to me explains about 90% of what you need to know to do well in personal finances over the long run. And everything else, the other 10%, just tends to be more complicated, more exciting. But just because it's exciting and intellectually stimulating doesn't necessarily mean it's going to move the needle more than the simple basic stuff that is easy to overlook. So whenever I explain that, I think actually that explanation of focusing on the basic stuff, that is most relevant for the sophisticated financial professional, the highly educated person. That's not my advice for the basic people who are just getting into it. That's my advice for the professionals, because they are the people, the high IQ, high educated, lots of financial training. Those are the people that are most likely to discount and ignore the basic stuff because it's not intellectually stimulating for them.
Our personal experience shapes our approach towards money.
Back to personal finance being more personal than it is finance. The way that everyone views investing risk and the way that they view opportunity and where they view the economy or the stock market going next is heavily influenced by their own unique experiences in life. What have you seen in life? What have you experienced? What have you been through? And those experiences obviously vary massively from person to person and generation to generation. So if you grew up during the Great Depression, you are obviously going to think something very different about the economy and the stock market than someone like myself, who was born in the 1980s and grew up seeing something very different. And if you came of age in the 1970s and 1980s, your view on inflation is going to be very different from my view on inflation, because there's been virtually no inflation, no meaningful inflation throughout my life. And that is not because one generation is smarter than another or has better information, just because we've seen something totally different. And then so when you realize that your own personal experiences are going to be more persuasive to you than anything else that you read or try to learn about. Like, I can try to put myself in someone's shoes who grew up in the Great Depression. I can read about it and try to empathize with it, but I don't have the emotional scar tissue that they do. And therefore, we're going to come to different conclusions, even if we're looking at the same information.
A takeaway from that is that according to Morgan Housel, reasonable people can come to different conclusions. And there is nothing wrong with it. He claims that the essential topic of money is influenced by your personal experiences, family history, and the times you were brought up in. The key is to figure out what works best for you personally without judging other people's decisions, simply because you don't know the bigger picture here. You don't know what is the reason behind their approach and what influences their decision-making process. Our emotions influence our financial decisions. Morgan Housel says that you can have the best and most exquisite financial background, but it's for nothing if you can't control your emotions when it comes to making financial decisions. So whether you feel fear or greed so you can make irrational financial decisions like selling the stock prematurely, or when you don't have a sense of having enough and being perfectly at peace with the way you live below your means, having these emotions takes control over your personal finances.
If you panic in March of 2020 or in September 2008, then none of the IQ that you have is going to make that much of a difference. And on the other hand, if you are someone who has a great control over their relationship with greed and fear and is not persuaded by marketing and whatnot, and you are just a long-term patient investor who's going to leave it alone, hands off, you do not need a deep financial education, financial background. You don't need to know how to calculate net present value down to the 5th decimal point. You don't need to know how to build a discounted cash flow model. If you just have the control over your behaviors and not much else, you can not only do okay, you can do sensational in investing.
Why can people with no formal finance training have excellent investment records? He claims that financial success is not a hard science and it's a soft skill, where how you behave is more important than what you know. And here's an explanation of what it means.
And this is to me is kind of the premise of my book. It's just that good investing is not about what you know. It's not about how smart you are or where you went to school or how sophisticated the Excel model you have is. Good investing is overwhelmingly just about how you behave. It's about your relationship with greed and fear and your ability to take a long-term mindset and who you trust, how gullible you are, those kind of things. And to me, the most important part is that behavior is hard to teach. It's almost impossible to teach, even to someone who's very smart. You can teach them calculus and you can teach them data analysis. You can teach them how to read a balance sheet, but you can't teach people how to be patient. It's just some people have it and some people don't. That can be disheartening to hear, but I think it's really true. And all the evidence that we have shows that that is true. That I don't think there's any evidence, unless we're talking about like the marshmallow test at like a really basic level. I don't think there's much evidence that people who are extremely intelligent are also going to be patient investors, or the opposite. The people who don't have a lot of training and sophistication, those people can be patient, very successful investors. And I think it's just very easy to overlook that in this industry, the disconnect between behavior and intelligence.
So as you can see, Morgan Housel sheds more light on this concept that there is no magic secret financial formula that you can learn today and apply tomorrow to every single investing opportunity you may want to pursue. Very often, people with no formal financial experience or education share one trait which brings them closer to actual wealth. It's patience. He claims that patience is the one thing you can't teach someone, which is the basics of being able to take advantage of compounding.
There's a story in the news of a very humble person, a janitor, a secretary, whoever it might be, dies and leaves millions of dollars to charity, and no one knew that they had this money. Every year, one of these stories comes about. There's a story about a woman named Grace Groner. I use the story in the book of a janitor who did the same thing. And what's interesting is that, so that happens in investing, that complete novices who come from humble backgrounds do very well. And they happen a lot. I don't think they are really necessarily like crazy 1 in a million anecdotes. There are, if you look at the vast majority of investment dollars in the United States, the vast majority of dollars are for people who contribute from their 401k. Every other Friday, they put $200 or whatever in their 401k and they invest it in an index fund and they never touch it for decades. That's the majority of investment dollars that happens. Most investors, to that extent that they're just dollar cost averaging in their 401k, are really good investors. What we hear about and what we see and what moves the market are the people who are fiddling with the knobs. The hedge fund managers, the traders, the day traders, the Robinhood investors, etc., that are constantly fiddling. But the vast majority of investors are actually doing great. And the vast majority of investors, even if they don't know it, are outperforming some of the best investors in the world.
These were the top takeaways that share a fascinating perspective of approaching your financial habits and investment decisions. Next time you feel pressured to take an action because you heard on the news it's now or never, think twice about who you compare yourself to. Thank you for watching. If you liked this video, like and subscribe to our channel. And don't forget to watch other videos we made. You should be prepared to talk about your contribution to the company's welfare in the future. Here's the thing. Most of the time we think that this is the right time for a raise because we already have performed a certain way until now, by fulfilling different requirements, key performance indicators, or financial targets. We think of ourselves as model employees and therefore we approach the idea of earning more money for self-centered reasons.